Good evening, everyone.
Good evening.
Yeah, I hope we are all doing well.
Mm,
Okay. Yeah. Do you know what I like about you people? Like, people, you are really committed. You see, I have 42 people on. Like, it means that you people really mean business. So I pray that we all make this particular thing successful. We should all pass.
Amen.
Amen. And we are time conscious.
Amen.
Because I believe that, like, God is not from Africa. So if you are hardworking, God will surely bless you. So He will reward you for all your time, your effort, and everything. But I can assure you that financial reporting and corporate reporting, you have a higher chance of passing. So you just have to take whatever we are doing over here very serious. You have a high chance of passing. Okay, I can assure you that. I can assure you that. All right, so we started with where did we stop the last time? I hope we stop at gearing ratios, isn't it?
Yes.
yeah.
Okay. So today we will continue with the rest of the two ratios, and we also look at common size. We try to solve a question, and we also look at how you write a report. And maybe we solve, like, maybe if we are not able to solve two questions, at least we should be able to solve one question and use that particular question to write a report. And maybe let's see how we can go about that. So without wasting much time, let's get into it. Let's get into it. So what we are coming to look at today is we are going to look at how the company manages its short-term resources. How the company manages its short-term resources. So we are also going to look at working capital management ratios or efficiency ratios. Working capital management ratios or efficiency ratios. So we look at working capital management or efficiency ratios. Okay. So people are still joining. Okay. So we are going to look at working capital management ratios or efficiency ratios. The working capital management ratios, we normally calculate them to know if the company is managing its working capital very well, if they are managing their working capital very well. What do you mean by working capital? Working capital, what do we mean by working capital? Working capital. What do we mean by working capital? Auntie Eunice, working capital.
Yeah. Linus.
Yes, please. Yeah, Sinasamo, working capital.
Yes, working capital is the amount of money in which a business used to finance their daily operations.
Okay.
So
Okay.
basically, their current assets less their current liabilities.
Okay. Okay. So working capital, basically, we are talking about the items that we use to finance the day-to-day operations of an entity. So the items that we use, so the items that we use to finance the day-to-day operations of the company. That is what we call the working capital items. Working capital items. So basically, we are going to look at least 3 of them. We are going to look at least 3 of them. We have the working capital items that we are going to look at. The first one will be inventory. How do we check whether the company is managing its inventory very well? How do we check whether the company is managing its inventory very well? Another one is the receivables. We also check if they are managing their receivables very well. And we also check how they are managing their payables very well. Most sometimes they can ask you about the cash operating cycle, but that is something that might be for financial accounting. Okay. How will you know that a company is managing its inventory very well? How will you know that they are managing their inventory very well? How will you know that? How will you be able to determine whether the company is managing their inventory very well or they are not managing their inventory very well? How will you determine that?
Yes, so I believe we can look at it from the point of their inventory turnover.
Okay. Okay.
Yes.
So if the inventory turnover is very high, what does it mean? If it is very low, what does it mean?
So if the turnover is very low, I think it means that they are able to generate cash flow, or they are able to sell more of their goods. Then if it is very high, it means they keep a lot of their inventory in stock, so they are unable to turn it around to get more cash for their operations.
Okay. Okay. That is nice. That is nice. So if it is too low, like inventory turnover is like 0.1, is that good? If, yeah, yeah, Senior Gerson, if the inventory turnover is 0.1, we are saying that if it's too low, it means that they were able to dispose their stock, isn't it? That is what you are saying, isn't it? And I'm asking
Yes.
that if it is 0.1, would that be too good for the company?
Well, I think
No.
it will not be that good.
Why?
Because you let me think about it and come back again.
Yes,
Senior.
Samuel.
Because the company may run out of stock
Okay,
and may be unable to supply its customers.
okay. There might be urgent demand which they cannot be able to meet, isn't it?
Yes.
Okay, that is also nice. That is also nice. So if you are disposing much of your stock, it is likely possible that you will be there. One of your favorite customer will come and you will not be able to supply them. Okay. So does it also mean that a company should have a higher stock, higher closing stock? Taking it from this perspective, does it also mean that a company should be keeping much amount of stock?
Senior.
Yes, please.
Does it not also depend on the type of industry that is in question. For instance, if you go to the manufacturing industry, where they keep a lot of raw material, what will you say about that if you have a low or high as compared to the financial institutions?
Okay.
I don't know. So I just want
Yeah,
to
it depends
choose.
what, like, the answer that I want to give is the one that you are giving. The question that I asked, does it also mean that we should keep a higher stock? From that
Exactly.
perspective, if the person should give the answer, then that will be the conclusion that I will be.
So keeping a higher stock will lock the capital of the business.
Locked up the capital of the business. Okay, that is
Yes,
also nice.
the business may not be able to have funds to run other operations.
Okay, that is also nice. What else? What else? What else do
And
you
also,
think?
I also want to add that depending on
It
the
might,
type of
it might
inventory,
also pose
if
liquidity
it is
problems.
finished. Okay, Senior, you talk. After that, I come in.
No, I'm going to
I'm saying
I'm going to finalize everything. So you have to do the talking so that I will just come and do my last submission. Okay.
So I was saying that it will depend on the type of inventory. If it is finished product, keeping too much of it means you are not able to make sales, and you have cash locked up in your inventory. But if it is a raw material that you'll be needing for your production, if you have it, then once there's a need for it, you can quickly produce it into finished goods. But if you produce and it's still in stock and you're unable to sell, then that means you have locked up cash. But having a higher inventory in stock or having a high inventory in the warehouse is not that good. It has to be a balance, whether you can meet your supply and you have money when the need arise. Thank you.
Okay, that is also nice. But I want to ask whether you are saying raw material. I want to ask whether the company is going to dance before they will give them the raw material, if they are not going to use cash for it.
They will use cash for the
The raw
purchase
material.
of those raw material. Yes.
So if you are keeping more, you are not locking up cash there.
No, you are looking. So that's why I said that there need to be a balance
Okay.
as
Okay.
to how you are the quantity that you are keeping and what you are not keeping. Yes.
Okay. Yeah, another problem is also that it depends on the inventory. If the
Well,
inventory, all right, Senior. Yes, now Patrick, you can talk.
okay. So I would say that in any good company, they should have policies in place as to what they deem as high stock. So every company would have a minimum stock level, a maximum stock level. So if anything is going above the maximum stock level, then it's inappropriate. So it is going to be based on the trend of the company. That is how you are going to set your maximum or the minimum stock levels.
Okay. All right. That is also nice. The issue is it is not appropriate to keep a lower level of stock, and it is also not appropriate to keep a higher level of stock. Whatever you're going to do, you have to make sure that it is efficient. And mostly it depends on the industry. It depends on the nature of the company's stock. If you are keeping low stock, someone said that you might not be able to meet the demand of one of your favorite customers. If you're also keeping a higher stock, you are locking up cash, and it is likely possible that some of the inventory might go damaged and you are going to write them off as a loss. So some of the inventory might become obsolete. Assuming you have typewriter, a company should keep maybe 10 million typewriters in stock before they will bring computer. The typewriter will still be there. They become obsolete. They have no use, and the company is going to lose. So whatever you are going to do, whatever stock level they are going to keep, should be efficient. Should not be high. Should not be too low. It should be average, and sometimes it depends on the industry in which the company is operating in which the company is operating. Though you are not going to do something that is practical, they are going to give you a question about two companies, or they will give you a question about just a company, but it will be 2 years. So you calculate the ratios for them and look at the previous year, compare the current year to it, and see if there is any increase. Then you now do your analysis based on the figures that you have gotten. It's not practical something that you're going to do. So they will give you a statement of two companies, you calculate their ratios, then you compare. You compare the figures. So it is a figure that you're going to use as a benchmark to say that this person is keeping a higher stock because this person own is lower. So that is how you're going to do the comparison. It's not practical something that you're going to do. But if a company is keeping a lower stock level, it might be appropriate if the company is in the financial industry, because as a financial institution, what do you need more stock for? But the company is operating in the manufacturing industry, that will not be appropriate. So you look at it from this perspective. If they're in the financial industry, that will be appropriate because they are not producing, so they don't need much stock there. But if you are in manufacturing industry, it means that you might be needing more stock over there. So if you're in the manufacturing industry and you are keeping a lower level of stock, what is the implication? The implication is that you might not be able to meet demand of some of your regular customers on time. That's also one of the effects, one of the implications. But what you are going to do in the exam will be, they will give you a statement of two different companies. You calculate it and now compare their figures and do your analysis. Or they will give you a statement of a company which will be for 2 periods. Then you now calculate it and compare. Or they will give you a statement with the industry average. Then you now do your analysis based on what you have gotten in relative to the industry average. But what we are saying is that the level of industry or the amount of closing stock that a company should keep depends on the nature of the company's operation. It depends on the nature of the company's operation, and also the industry in which the company operates in. All right. So for the inventory, we mostly use 2 ratios to determine whether the company is efficient in disposing of their inventory or they are not. So the first ratio that we are going to look under the inventory is what we call inventory turnover rate. Inventory turnover rate. Inventory turnover rate. Inventory turnover rate. Sometimes they will not add a rate, but they will just say inventory turnover, which is calculated as cost of sales. Cost of sales divided by average inventory. But mostly in the exams, you will not be given average inventory. So you just use the closing stock. So, but it is average inventory. The correct formula is average inventory. But in the exam, they will not give you average inventory. They will just give you inventory for the closing inventory. So you assume that the closing inventory is the average inventory. So this will be times number of times. So cost of sales over average inventory. But in the exam, they will not give you the average. They will just give you the closing inventories in the balance sheet. Just assume that the inventory in the balance sheet is the average inventory. This ratio will tell you how efficient the company is in disposing their stock, or how many times it takes them to dispose their stock. So this also measures the efficiency of the company in disposing of their inventory. How many times did we dispose our inventory before realizing the cost of sales that we are reporting? How many times does it take us to get the cost of sales? If this is higher, it means that we are not efficient in disposing our inventory. We are not efficient. But it means that if it is lower, it means that maybe we are not disposing often, but whenever we dispose a large amount of what? The inventory. Whenever we dispose a large amount of inventory. So this also tells us about the efficiency, how efficient the company is if it comes to disposal of their inventory. That is about the inventory turnover rates. The next one is the inventory turnover period. Inventory turnover period. Inventory turnover period. The next one is the inventory turnover period. Inventory turnover period, which is the reciprocation of the inventory turnover rate, which is calculated as the average inventory over cost of sales times, maybe if you are doing it on daily basis, you multiply by 365 days. If you are doing it on monthly basis, you multiply by 12 months. If you are doing it on weekly basis, you multiply by 52 weeks. But mostly we do it on daily basis. If they have calculated a ratio already, and they're asking you to calculate the inventory turnover period, you have to ask yourself, how was the inventory turnover period calculated? If they are adding days to the period, then you also calculate by using days. If they are using weeks, you also use weeks. If they are using months, you also use months. Inventory turnover can also be calculated like this. Inventory turnover can also be calculated like this. Inventory turnover period. Inventory turnover period can also be calculated like this. 365 days over the inventory turnover rate. Inventory turnover rates. It can also be calculated as 365 days divided by inventory turnover rates. Inventory turnover rates. Have you seen this one before?
No.
No,
Okay.
please.
Okay. So in the exam, everything can happen. They can give you inventory turnover rate and they will now ask you to calculate the inventory turnover period. The best way you can do this is that divide the 365 days by the inventory turnover rate. Okay. What is the inventory? Look at the inventory turnover rate here. Look at the inventory turnover rate here. How is it calculated? It's calculated as cost of sales. It's calculated as cost of sales. It's calculated as cost of sales over average inventory. Okay. Let's look at something like that. So we have cost of sales. Let me put cost of sales here over the average inventory. That is how we calculate what? Inventory turnover rate. Am I correct? Okay. But we are saying
Yes.
that this is supposed to be 365 divided by this, isn't it? So cost of sales over average inventory. Okay. Let's do some small mathematics here. This will be same as 365. This divided by cost of sales over average inventory. What do? We change this to multiplication by reciprocating the second fraction. So this is 365 times average inventory over cost of sales. Very simple. Okay. So they can also give you that. Maybe you have learned something new today. Nobody knows. Okay. If you are doing business valuation, we need this ideology. You have to think a lot. Some of the ratios you have to think a lot. Now the institute is no longer giving you direct ratios to calculate. They can now give you ratios that you have to do some small mathematics before you can get the other figure and do your computation. So the inventory turnover period. What does the inventory turnover period tells us? What does the inventory turnover period tell us? Inventory turnover period. What does it tell us about the organization? Yes, Senior Patrick, you want to talk?
All right. So I think the inventory yes, sir. Yes. The inventory turnover period indicates the number of days that it takes the organization to convert its inventory to sales or revenue.
Okay. So if that to would that be like as a financial accountant, should that be should it be higher or it should be low? Should it be high or should be low? Yes, let me put it like that.
It should be low.
Why should it?
I think it should be high.
Yes, what I want to say is what the person is saying over here.
Hold on.
Yeah, what I want to say is what the person like Philip is saying over here. If it is higher, it means that the company is over trading.
Yes.
It's a testimony that I always give glory to God.
Okay, but if it is higher, no, if it is higher, that is not good. You see, if it is higher from the time that you are going to buy,
yes, it's taking a longer period to convert.
And some of the inventory might even go to what they might spoil. In the warehouse, they will spoil, and the company has to write them off. Are you okay? But if the inventory turnover is telling us from the time that you purchase the inventory, how many days from that time? How many days from that time before you are able to dispose it? You can see some of the inventory might be, if the item is a perishable item and the inventory turnover period is too long, it means that before you even dispose them, maybe 50% of the items are already bad. 50% of the items are already bad. But if you are a car dealer, ask yourself, if you are a car dealer, look at the nature of your business. If it is taking you 250 days to dispose of this one, you're even doing well. If you are into car dealing and it is taking you 250 days to dispose a car, you are doing well. Look at the amount of look at if you want to buy a car, just look at the price. But you are selling tomatoes. You are selling tomatoes, and it is taking you 150 days to sell tomatoes.
I said it will depend on the number of tomatoes you sell in 150 days.
No, if it's taking longer days,
even if it is depending on the number of tomatoes that you are selling, it's too much. Tomatoes square should not take you more than a week. But if you are using 250 days to sell a plane, look at plane. You are taking 250 days to sell. Look at this one. You are doing better. Look at the cost. This one, look at the price. If you want to buy a plane, look at the price. So if it is taking you 250 days to sell it, it is better. So sometimes the inventory days or inventory turnover period depends on the nature of the item that the company is selling. If you are selling a perishable item, it means that the turnover period should be short. If it is too long, it means that most of the item will go bad before you even dispose them, and you may end up disposing them for nothing. you may end up disposing them for nothing. So items with expiring dates, you have to make sure that the turnover period is not too long or it's not too high, and it's also not too short. If it is too short, then we can see that maybe you might be overutilizing your staff. So if you are selling a car and you are using 10 days to dispose the car, you are using 10 days, your turnover period on average is 10 days. What does it mean? Can you be able to sell car in Ghana within 10 days on average? It means that you are overutilizing your staff. Some people, you have to force them to go and look for people. It means that something might be wrong. Although all things can be equal, but something might be wrong. But look at car. You're selling car within 10 days. That means you are overutilizing your asset, or you are putting pressure on your assets or on your staff. So inventory turnover period should not be too higher and should not be too low. But in the exam, they are going to give you two companies, or they will give you a financial statement of a company for different years. Maybe it can be 3 years, it can be 2 years, it can be 1 year with an industry average. So what you are going to use as a benchmark over there is that if you are giving 2019 and 2020, you will now use 2019 as a benchmark. So if the inventory turnover days is 32 days over here, and it's now 50 days, then you can now comment that the inventory turnover period has increased. This shows that it is taking the company additional 18 days in 2020 to dispose its inventory. If the trend should continue like this, that means every year it is increasing by 18 days. The company might end up writing some of the inventory as obsolete inventory. That is how you are going to go about the report. So they will give you maybe two companies, you now calculate their ratio and compare. So this will now be the comparison. But what we are saying over here, we are talking as if we are being practical. But in the exam, they are going to give you financial statement of two different companies, or financial statement of a given company for different years. Then you now calculate, use the previous year as a benchmark to do the analysis for the current year. That is what you are going to say about it. But if it is too high, if it is increasing, it's not good. But depending on the nature of the company, depending on the nature of the item that the company is selling. But if it is increasing under exam condition, it's not good. Why is it not good? You say that it has increased by this number of days. What will happen if the thing should continue like this? What is the consequence of this? You can say that, then you move on. That's how we go about it. The next item will be receivables. The next item will be receivables. Okay. How will you know that a company is managing its receivables well? How will you know? How will you know that a company is managing its receivables very well, efficiently?
One is if the receivable days are less.
So you also have to know the implication of having a lesser receivable period. Do you know the implication of that?
The implication of having a lesser receivable days period.
Yes.
Depending on the nature of the industry, or
it has nothing to do with, let's assume that just a company, any company at all, having a lesser receivable days. What will be the effect of that on the company?
for that I can't tell.
Okay. Sinasamo.
The company may have essence funds, because if the receivable,
Assuming they are investing the excess funds, they don't have any problem. They are not having excess cash there. Whatever excess cash that they have, they are reinvesting it. What will happen?
So it means the company is probably exercising a very strict credit policy, which might discourage certain customers from doing business with them.
Not certain customers. It would discourage Africans from doing business with them. So if you're having a shorter receivable period, you might end up losing what? The customer base. Because some of the customers might not be able to what? To get that. Maybe if you want to ensure that the receivables are being received within 30 days. So those who cannot pay within 30 days, you are going to use quick credit people to go and collect the money for you because you need it. So some people might not be able to pay this, but you are going to use a very strict means to collect the money from them. So if they see that they won't be willing to do business with you again, they will go to a supplier or a company that can give them a favorable what? Receivables what? Period, or that can give them a favorable payment terms. So if you are having a shorter period, you might end up losing your relationship with some of the customers, because it's not everybody that will be able to get the money to pay within the 30 days that you're talking about. And you also need the money within the 30 days. So you are going to apply maybe certain aggressive methods to get your funds. So if you're having a shorter period, it can also affect your revenue. It can also affect your revenue, because some of the customers in the next period, they won't be willing to do business with you again. They won't be willing to do business with you again. So if you are calculating net profit margin and you realize that no, the net profit margin is now reducing, okay, you can see that the company is not able to manage their costs effectively. That is also one factor. The company has increased their price during the year. That is also reducing the revenue. But another factor is also has to do with the what? The receivable period of the company. If it is too short, it means that the company is now applying aggressive methods to receive their money from their customers. So as a result, some of the customers are being discouraged from purchasing from the company again. That can also reduce their revenue. So sometimes if you are doing that analysis, talking about what is causing the net profit margin to reduce, you can also look at the receivable days and also link with that particular explanation. Okay. You can also look at if you're also doing why the net profit margin is reducing, you can also use the inventory turnover period. Inventory turnover period. If it is too higher, you can also say it is the company is not disposing their inventory frequently. That is also making their revenue to reduce. So it's not only they are not able to control costs, their price has increased. Other factors will also account for that. One of them is the shorter receivable period. What is the implication of a company having a longer receivable period? We are saying that it should not be too short, but it's supposed not to be too long too. If it is too long, what is the implication? What is the implication? If it is too long, it is taking the company 250 days to receive.
You might have liquidity issue.
Okay.
And also bad debt.
The first one will be you are going to incur costs, which is the first one is the bad debt. Okay. And since the money are with the people, you may be forced to go and borrow money from somewhere to what?
Yes, incurring interest and other things.
You also incur a fixed cost, a finance cost. Okay, those who are doing management accounting, we look at working capital management and we talk about these issues. I say management accounting, financial management. All right. So the first one is that some of the people, maybe some of the customers, God not being so good, they can pass away and you can't receive your listing again. Some of them, they will not pay. So you will be incurring a bad debt. You can also go, because you are having the receivables there, you can also decide to go and borrow so that whenever the people pay, you use it to settle the amount of money that you have borrowed, and you are going to incur an interest on that. You can also decide to try to factor the receivables, sell the receivables to a factoring company, a debt collection company, where you are going to incur factory fees or FATA fees. They are going to charge you fees for that particular one too. So we are saying that the receivable period should not be too short. It should also not be what? Too long. But if the company wants to formulate a working capital management policy, they should consider everything. They should consider the nature of their operation. They should also consider their relationship with the customers. So nobody should be disadvantaged. It should be average, not too much, not what? Too long, not too short, not too long. If it is taking too long, it means that the company is not effective, it's not efficient in receiving or in collecting their receivables from the customers. Or we can say that the company is having a longer cash operating cycle. Because we know that the cash that we have will be put in inventory, then the inventory will now be turned to receivables, then receivables will now be turned to cash again. But if it is taking you longer to take your receivable, it means that the company will not be having enough cash to even finance its inventory again, its operations again. All right. So the inventory, the receivable period is telling us how long it takes a company to convert its receivables into cash. If it is too long, you are going to have liquidity problem. You are going to incur costs associated with receivables, which is bad debt, finance costs, factoring, and those things. All right, let's look at another one that we call. Another one is what we call receivables turnover rate. Okay, did I say something about receivable period? Okay, I didn't say anything about that. So it's receivables. It can also be called receivables turnover period. Receivables turnover period. So receivable turnover or collection period, which is calculated as what? How is it calculated? It is calculated as what? Receivable turnover or collection period is calculated as
total sales.
Sales
Receivables.
minus receivables.
okay, average receivables divided by credit sales. Okay. Okay. So the credit sales we okay. We can only have
times
receivables.
365.
Okay, we can only have receivables when we sell on credit. So the receivables, we are saying that, okay, out of the total sales, out of the total credit sales that we have made, how many days is it that taking us to collect our receivables? So we take the receivables, which is average. But in the exam, they will not give you average receivables, and they will also not tell you the component. They will just give you total revenue. They will just put revenue in the statement of profit or loss account. And we know revenue can be both cash or credit, but they will not tell you which part of the revenue is cash and which component of it is what is credit. So you just assume that the entire revenue over there is on credit. The question will not give you the component of the revenue that is for cash and that is also for credit. So what you do is that you just take the entire revenue in the statement of profit or loss as credit sales times 365. The question will also not give you the information on opening receivables and closing receivables. They only give you one receivables figure. So what you are going to do is that you only take the receivables figure over there as the average receivables over the revenue figure, then you multiply by 365 days. Okay. Another one is another thing that we look at under receivables is receivables turnover rate. Receivables turnover rates. How is it calculated? Receivables turnover rates. Receivables turnover rate. Look at the inventory turnover rate. How is the inventory turnover rate calculated? With reference to the inventory turnover rate, how do you think the receivables turnover rate will be calculated?
Credit sales over average receivables.
So credit sales or revenue over revenue over average receivables times the number of times. Okay, what is this ratio telling us? What is the usefulness of this ratio? Yes, HP. HP, your hand is up.
I'm speaking. The rate at which you are able to collect your receivables or your monies from your sales.
Okay, that can also be okay. That is also okay. That is also okay. We can also see the number of times that you are able to receive your that one. Okay. You can also see the number of times or the number of credit sales that you have made to generate your revenue. We can also talk about that. But mostly this is not something that you are going to see, but we are just exploring all the alternatives. Anything can happen. So they ask you receivables turnover rate. It is the reciprocal of the receivables turnover or the receivable collection period. This ratio is telling us that how many times do we sell on credit before getting the revenue that we are reporting there. So if it's taking you longer, if it is taking you higher, it means that you are making a lot of credit sales before generating the revenue. But if it is 2.0, it means that, okay, you sell twice on credit to get that particular revenue that you are reporting, which is nice. Maybe the credit sales are not much, so collecting your debt will not be that too stressful for you. But if you are having 10 times, no, you have to sell on credit 10 times before you are getting the revenue. Okay, that sells. Not every other people are going to pay. So mostly the turnover rates will determine how the collection period will also be. If the turnover rate is higher, the collection will also be higher. If the turnover is higher, the collection will also be higher, because if you are selling more on credit, it will take you also longer to collect the money. All right, let's look at payables. Let's look at payables. Let's look at the next working capital item, which is payables. So we look at payables. The payables too, we look at two ratios under them, which is the first one is a payables turnover period or payment period or turnover period. Okay, before I will say something, the receivables collection or turnover period can also be calculated like this. Before we move on to the payables, the receivables collection period can also be calculated as, this one can also be calculated as the receivables collection period. Yes, Emmanuel. Emmanuel, you are saying that question. What is the difference between the collection period for receivables and the receivable turnover rate? Okay, someone should answer. What is the difference? What's the difference? Someone should answer. He's asking the difference. Senior Patrick, answer him. He's asking the difference between HP.
Can it be the rate at which the number of times you are able to receive your sales after you have made your credit sales? Like, I mean, the number of times you are able to receive your cash after sales within a specified a period, for example, the 365 days in a year.
Are you talking about the period or the turnover rate?
That one is the turnover rate, but the period will be the number of days it takes, for example.
Okay. So the period. Okay.
I don't know if that makes sense.
The period is the number of days that it has taken you to collect the money after you make credit sales. That is the period. Okay. The turnover rate is the number of times that you have to sell on credit before getting the revenue. The number of credit sales that you have made to get the revenue that you are reporting. Because the receivable is credit sales. So the number of times that you have to sell on credit to get the revenue that you are reporting. But the period is the number of days, how long it takes you to collect your receivables or to turn your receivables into cash. Okay. Emmanuel, I hope you are okay now. So that will. Okay. All right, let's move on. All right. So I'm saying that the receivable turnover period the receivable collection period can also be calculated as 365 days divided by the receivable turnover rate. Receivable turnover rate can also be calculated like this. So the receivable collection period can also be calculated as the receivable turnover rate. So in the exam, they can give you only the turnover rate and they will ask you to calculate the collection period. You just have to divide the rate by 365 days to get a particular answer. Let's look at payables. Payables. The payables, the first one is the payables payment what? The payables payment period or the payables turnover period, which is calculated as the payables payment period, which is a PPP, is calculated as, how is it calculated? Payables payment period. Or
It's average trade payables over annual purchase times 365 days.
Okay. Average payables over credit purchases. Credit purchases. But in the exam, they will not give you this. So we assume that cost of sales is the purchases times 365 days. What is it telling us?
The number of days it takes us to pay our suppliers.
Okay. So this one, what should it be higher or should be low?
Should be higher.
It should be high. You are thinking about yourself. You're not thinking
Should be
about the
low.
person. You are thinking about yourself. You are not thinking about the person.
It should take me more time, more days to pay my supplier.
If you deposit money in the bank and the bank is telling you that if you want to withdraw the money, they are giving you a long time frame, will you be happy?
No, I wouldn't be happy. But if you let's say you sell for me, it should take me a longer time to pay you.
No. If you are not going to be happy because it's your money with the bank will be happy because they are taking longer to settle you. So you will not be happy, but the bank will be happy. So what do we do so that the two of us will be happy? You see, if I struggle to collect my money from you, next time I will not supply to you again. Do you know that?
No, it will depend on if the bargaining credit terms. If I should
No, the
bargain
thing
for
is, we are saying that no supplier is going to give you a long payment period. No. So if it is taking longer, it means that you are defaulting your credit terms. That's why it is taking you longer because no supplier is going to give you, because they will also get the money and go and buy additional stock. If the
so what
money
is
is
ideal
with you,
situation?
the ideal is it's supposed not to be too short and it's supposed not to be too long. The two of you should count so that you agree on something that will favor the two of you. It should not be too short. If it is too short, it will go against you because you will be using cash to settle and you'll be out of cash. You may need cash. If you are also taking longer, it means that the person will also be going somewhere for cash. So as soon as the person has collected the money from you, the person will not be willing to do business with you again. The relationship that you are going to have with the person will be damaged. He will not be willing to do business with you again.
So my argument is, if you are given, say, 15 days to pay,
Yes.
and you started beating around after the 15 days, that is different. But when you are able to bargain for 60 days, and it's agreed,
if it is bargain and the two of you agree on it, then that is fine. Because the other person has also
yes, that is what I
60
mean.
60 days is not too much.
That is what I mean. Not like you, after the agreed period, then you'll be playing around, oh, this, that, and nobody will supply you.
Okay. Okay. So if it is an agreement between the two of you, then nobody is going to complain. But we are talking about you deciding to take longer to pay.
Okay, I understand you say.
Yeah, you deciding to take longer to pay. If you and the supplier, you have agreed to, it means that the supplier is okay with that particular one. That is the credit term given to you. But you taking longer, they have given you 60 days, and now you are taking 100 days to pay. That's what we are talking about.
Okay.
Okay. But if you are giving a question in the exam, and the credit terms, like the payment period is increasing, that will be good for the company. But the question now is if the sequence should increase like that, if the increase should be in that sequence, what will be the effects in the near future? So you also comment on the effects in a year's time, not today. But if it is increasing, that is good because the company will be saving some cash to do other stuff. But if it is increasing like that, what will happen? Suppliers will be this. Even if you are able to agree on that, the person can agree and the person will refuse to supply you. You call them and they will not take your call. All right. Let's come to the payables turnover rates. Payables turnover rates. Okay. You see, the working capital management ratios. The one that we are looking at is the management ratios has to do with the this. But whenever they ask you about the efficiency, The efficiency, that is why you bring in the turnover rate, the turnover rate, the turnover rate. Okay, but you can still bring in the period to also explain the efficiency. To also explain the efficiency. But whenever they talk about efficiency, that is why we bring the turnover rate. Okay, so the inventory turnover rate will be calculated as what? Inventory turnover rate.
Cost of sales over average payable.
Cost of sales over what? Average payables. For examination sake, it will be cost of sales over average payables times the number of times. Okay. What is it? What is this telling us? What is it telling us? What is this telling us? Why do we calculate this ratio? Why are we calculating this ratio? Okay. So from this, let's look at this. We come back later. You people should be thinking about why we are calculating that ratio. From this, we can see that the payables settlement period can be calculated as what? Can also be calculated as what? Payables payment period can also be calculated as what? Can also be calculated
365 days
365
over
days
payables turnover rates.
over payables turnover rates. Okay, that is nice. Okay. Okay, let's now count the payable turnover rates. What is it telling us? Okay. The payables turnover rate is telling us the number of times it takes us to settle our, okay, someone else. Consider the rate it takes to pay monies after credit purchases. Okay, that is nice. That is nice. The number of times that it takes the company to settle its payables or its credit purchases. That is the reason. So if it is taking you more time, it means that will be favorable for you because it is taking you more time to pay. It means that you are paying small. But if it is higher, it means that you are paying, whenever you pay, you are paying a huge amount of money. Whenever you pay, you are paying a huge amount of money. So if it is taking you more times to pay, it will be favorable to the company, but it will be unfavorable to the supplier, because if you are taking 10 times and the amount is 5,000, it means that every time that you are going to pay, you pay 500 cedis. But if it is 5,000 that it is taking you maybe 3 times to pay, it means that whenever you are going to pay, you pay more than 500, and the supplier will be happy with that, and you will be suffering because you are using more cash to pay. And if it's taking you longer, it means that 5,000 10 times, every time you pay 500, but the supplier will not be okay because 500, what am I going to use 500 for? Before you know, the 500 will get finished. But whenever you pay and you pay a huge amount of money, the supplier will be happy and you will be suffering. Okay. So if it is too much, that will be good for you, and that will also be bad for the supplier. So whenever you are looking at this, you look at the two perspectives. If it is favoring you, you consider the person also, or the implication that that particular situation will bring to the company. Let's look at one of the efficiency ratio again, which we call the asset turnover. Asset turnover. So one of the efficiency ratio is the asset turnover ratio. Okay. Sometimes the question can tell you fixed asset turnover, But when the question say asset turnover, don't use fixed assets, rather use net assets. If the question just say calculate asset turnover, then you use net assets. But if the question specifically states that calculate fixed asset or non-current asset turnover, then you have to use your non-current assets. But if the question say calculate asset turnover, then use net assets for the turnover. Let's look at the asset turnover. If the question says calculate asset turnover, then it is calculated as what? Asset turnover. Asset turnover is calculated as what?
Net assets. Sales over capital employed.
Okay. So it will be revenue over net assets or capital employed times 100. I say times 100 times the number of times times number of times times the number of times. Why are we if the question say fixed asset, then the net asset will be fixed assets. Okay. But mostly the question will tell you that calculate asset turnover. So you just use your total net assets. Okay. What does this ratio tell us? What does this ratio tell us? What does this ratio tell us? Or what is the usefulness of this ratio?
Okay, so can we say that it helps us to assess the effectiveness in generating sales from investments in fixed assets?
Okay, that is nice. That is nice. But before I want to say something, if you are calculating your net assets in practice, if you're calculating your net assets, intangibles should not be part, like patent rights, development expenditure. You can see that you can't use those things to generate revenue, isn't it? They will not be used to generate revenue. So whenever you are calculating your net assets, you can decide to exclude the intangibles because they will not be used to generate revenue. They will not be used to generate revenue. So mostly we look at the property, plant, and equipment together with the current assets. But in the exam, you can just find your total net asset and just use it. But in practice, intangibles will not be used to generate revenue. They have nothing. If you have a good name, how is that? It's just contributing to the bank. If you are not using it to generate the revenue physically, it's only the delivery van that you use to take the items from. They are involving in the direct generation of the revenue. But whenever you have this, you just take your total net asset, whether tangible or tangible is not there or intangible is not there. Take all in the exam. You have to take all. That is in the exam. But in the practice, intangible should not be included in net assets when you are calculating your asset turnover. Let's come to the
in short, it's total asset.
No, it's total asset minus current liabilities. Yeah, Emmanuel.
Oh, sorry, yeah.
All right. Yeah, Emmanuel, your hand is up.
Yes, please. Please, you said that in practice, when you are calculating the asset turnover ratio, we do not consider non-tangible assets.
Intangible assets.
Intangible assets.
Yes.
And I'm asking that intangible assets such as goodwill, in a way, has an effect on the level of sales of an institution. So why don't we consider them?
It has effects on the level of revenue for the company. What if you don't have the building, the delivery van, and those things to take the items to maybe the customer or the market that you are selling it? The goodwill will not have a much effect on it. Are you okay?
Yeah, but
It is difficult to measure goodwill in generating revenue. How can we measure goodwill as against revenue? We can't. But the assets can easily be measured against revenue.
Okay. Thank you, Mr. Patrick. Your point is well understood. Thank you.
Okay. So Emma, you're okay now?
Please.
Okay, let's move on. All right. So let's look at the asset turnover. What is the usefulness of this particular ratio, asset turnover? What is it telling us?
Let me try.
Oh, everybody can talk. So don't say you want to try. Be confident
I
and
want
talk.
to try because I'm not sure.
Okay.
Be sure.
Is it about how much your assets fetch you? Like how much your assets make in terms of return?
Okay, that will also be taken. That will also be taken.
That is what I said I want to try.
Yeah. It's correct. It's not that you are trying. You are actually saying the correct thing. Asset turnover. Okay, let me just assume that the asset turnover ratio after calculating it is 2.4 times. What is the meaning of this? Let's just use number. Let's assume that it's 2.4 times. What is the meaning of that?
I think the meaning of 2.4 times means that the entity can use its current net assets to generate revenue at that number of times.
Okay. So what if you are given this, if you calculate your asset turnover and you have gotten something like this, will you say that the company is efficient in utilizing the assets?
It will depend on what you are matching against, the indicators that you are matching against, whether you are doing an internal analysis or external analysis.
Assuming there is no indicators.
Hello.
Yeah, Emmanuel, you want to talk?
Yes, please.
Yeah.
Please, does the 2.4 times implies that for maybe a CD of every net asset used by a company, they are able to generate 2.4 CDs as revenue from the use of its assets?
Exactly. That's what I
Okay,
want to say.
thank you.
All right. I even want to use a figure for that because you can see that we are matching what we are using currency, we are using figure, we are using money. So it means that the top over here is 2.4 and this one is 1. That is why we are having 2.4. So this is the same as 2.4 over 1. So for every 1 cedi of the assets used is generating what 2.4 Ghana what cedi. Or for every dollar of the asset that is being used, it is generating what $2.4 in return. With that, someone can say the company is doing well, but I can also say that there is a problem. Although they are doing well, but there is a problem. Where would the problem be coming from? Why do you think 2.4 can be a problem to the company? Why do you think 2.4? You are using 1 cedi to generate what? 2.4.
So I can say that there is I can say that there will be a pressure on the assets, the company's assets.
They might be overutilizing the what? The assets. Which in the long run, the efficiency of the asset will reduce and the asset turnover rate will also be, they might be pushing pressure on the asset. They might be overutilizing the assets beyond its capacity. That can also be a problem. But if that is not the case, they are just utilizing the asset within its maximum capacity, then we can say that the company is actually doing well. So the asset turnover is telling us for every 1 cedi of the asset value that the company is using, how much revenue is it generating in return? So if you are getting 0.4 times, it means that the company is not efficient in managing or in utilizing their assets. Another one is if you want to tell us why the gross profit margin is increasing, why the net profit margin is also increasing, you can also use the asset turnover ratio. The asset turnover ratio. If the company is utilizing their assets very well, the revenue will increase. So the increment in the revenue can also be due to the efficient utilization of the company's assets. So not all the times the company is able to control costs. Sometimes they might not be able to control costs, but just that they are utilizing their assets efficiently, that is increasing their revenue. Not that the demand has increased. It can also be due to the asset turnover ratio that is making the company to increase their revenue. Let's look at investment ratio.
Mr. I
Yes.
have a question, please.
Okay.
I want to also find out that could it also be that because the asset is new, or maybe it could be that the asset is new, that is giving that huge value? Because in the long run, if the assets begin to fall in value, this figure might have fallen too.
Yeah, that can also be a problem. But assets can be new, but you'll not be utilizing it to its full capacity.
Okay.
You can still have a new asset, but it will be underutilized. Do you agree with that one?
Yes.
Okay. If you bought a new asset and they say its maximum capacity is 75,000. This capacity will be reducing if you start over utilizing the asset from the beginning. If you're using the asset to the 75,000, it is possible that every year the capacity will be 75,000, because that is how they program the asset. They say that its maximum capacity is 75,000. Although you are using it, the only time this will reduce is where you have overutilized the asset. That is why the efficiency might be declining.
Okay.
That is why the efficiency might be declining. So it can also be because the asset is new, fine. But it can also be like the asset can be new, but it will be underutilized. All right.
Okay.
Okay.
Yeah.
Let's move on to investment ratios. Investment ratios. Investment ratios are very okay. Okay. Hey, my people are good though, Jerry. This one is free 20 marks. Okay. Free 20 marks. All right. Let's come to investment ratios. Investment ratios. What are investment ratios? I know they will not ask you this in the exam. What are investment ratios? Okay, before I move on, assuming in the exam, they ask you to calculate two ratios that are important to the lenders and two ratios that are important to the investors. What two ratios are you going to calculate for these two categories of people? Lenders and investors. They say you should calculate two important ratios for investors and two important ratios for lenders. Lenders. For the lenders, who are they talking about?
Lenders, I think profitability.
For the lenders, if they are saying lenders, who are they talking about?
The
We are
lenders
talking about who are lend money to the
a company.
company.
So what
Yes.
are the two important ratios that they look at?
Come again.
What are the two
So,
important ratios that they look at? What are the two important ratios that they might
I
be
think
looking
it's the liquidity ratio.
at? Assuming they are lenders will not be people that will be giving interest.
Check your mics. Check your mics.
I think they will be looking at liquidity or liquidity.
Interest cover.
No, it depends.
No.
Yes, interest cover is one of them. Interest cover is one of them.
So return on capital employed.
No, that is lenders will not look at the return on capital employed.
Look at the
Okay.
debt service ratio.
dividend cover.
No, dividend cover will be for the investors.
Debt to equity.
Debt to equity, they will look at the debt to equity. They
Debt
will look,
service ratio.
yeah, they will look at only the gearing ratio. They are talking about the gearing ratio. The investors, we are not talking about short-term the lenders, we are not talking about short-term people that will give you money for maybe 2 period or something. But if you are talking about some people that will give you money for 2 years or a year, then we count the liquidity ratio. But the lenders, we are talking about those people that are going to give you money for a longer period of time, long-term debt. So you talk about a gearing ratio. They will be looking at a debt to equity ratio. What is your debt to equity ratio already? If you're having more debt, then it means that you cannot even have money, or you cannot even pay our own, because you already have more burden in terms of debt. If your debt to, or if your capital gearing ratio is higher, it means that you are already in a problem. We can't give you money again. You are not willing to pay, or you are not done paying these people. You already have more debt. You want to add it again. It means that at the end of the day, our money can even lock up. The interest cover. Do you have enough profit to cover your interest? If the interest cover is higher, it means that even if you give you the money, you can use much of our profit to settle us, though profit is not cash. But if the company is dealing in cash transactions, it means that their profit will be the same as cash. So if they say if they say lenders ratio, they are talking about the gearing ratio, the gearing ratio. But if they are talking about investors ratio, we are looking at the ratios that investors that they will see, and they will be attracted to invest in the company. And one of them is the return on equity, return on capital employed, and some of them that we are coming to look at right now. All right. So if we talk about investment ratios, we are talking about ratios that are of importance to the potential investors, to the potential investors, to the potential investors. So what are some of the ratios do you think potential investors will see, and they will decide to invest in a particular company? Forget about the return on capital employed and return on equity. We have done that already. What are some of the ratios? The first one is the
Earnings per share.
earnings per share, which is calculated as what?
Earnings per share is calculated as
Net profit attributable to shareholders is done on shares.
Paid earnings over shares.
No, please.
Okay, hello, sir.
Yes, please. I can hear you.
Earnings per share is calculated as earnings. Hello.
Yes, I can hear you, Zina.
Yes, earnings minus preference dividends over equity number of shares.
Okay. So we can see ordinary earnings. That is earnings attributable to the ordinary shareholders.
So what about profit after tax?
Profit afterwards.
After tax.
No. If we have preference shares. The preference shares dividend will be taken from the profit after tax. But we can only have profit after tax when there is no preference shares. Are you okay? So we can say ordinary earnings, which is earnings attributable to ordinary shareholders, divided by a number of ordinary shares. Yes, Emma?
Yeah, sir, please,
Yes.
I'd like to know if it implies that with reference to the preference shares, the preference shareholders, they are seen as lenders to the institution, or
The preference shareholders are always creditors to the company. They don't have ownership.
okay.
All right. But we also have this one in the preference shareholders can be redeemable or irredeemable. Okay. For
Yes,
the
please.
redeemable preference shares, their interests are being treated as finance costs. But in the exam, if you have preference shares there, just take their dividend, whether it is redeemable or irredeemable. Assume that their interest or their dividends are not treated as finance costs. If you come to financial instruments, the redeemable preference shares, their interest, their dividend paid to them are treated as a finance cost. It's only irredeemable preference shares that their dividends are treated as part of the ordinary dividends. But in the exam, whenever you see preference shares, whether redeemable or irredeemable, preference shares do not have ownership. So the earnings per share, we are calculating it for only the owners, which are the ordinary shareholders. So if you want to include preference shares in the calculation, it means that the down over here should be the shares of ordinary shareholders plus the shares of what? Preference shareholders. But since only you are using number of ordinary shareholders, it means that the profit must also be the profit attributable to what? To the ordinary shareholders. Okay, so the preference shareholders are seen as creditors to the company. They don't have ownership. And the investment ratios are always calculated for the owners. They are always calculated for the owners. Okay?
Linus,
Yes, yeah.
sorry, the earnings per share,
Yes, please.
if you should calculate it this way, cost of capital
Okay.
over weighted average number of shares. Is that one also wrong?
No, for ratio analysis, you are not going to use a weighted average number of shares because they are not even expecting you to come and weigh the shares. That can only be applicable when you are dealing with earnings per share, IS 33. So that one, they will expect you to calculate the weighted average number of shares.
Oh, okay.
Yeah. So for the purpose of ratio analysis, we only use the number of ordinary shares, but not you see, we have two types of shares. We have authorized shares and what? You can have shares in issue, or you have shares what? Or you have subscribed shares. So the question can give you authorized shares and also subscribed shares or shares in issue. Which of them are you going to use? Authorized shares and shares in issue.
Shares in issue.
Shares issued.
Okay.
Shares in issue.
Okay. So what about the authorized shares? What will happen to the authorized shares?
You ignore.
Why are you ignoring?
Because the authorized shares shows the total number of shares that the company can issue to the general public.
Okay. So whenever you see authorized shares, that is the shares given to the company, maybe at the date of registration. That is the total number of shares they can issue within their capacity. But they can issue all these shares, but not all of them will be what? Will be taken. So the shares in issue is the actual shares that have been taken by the public. So you can only become owners if you subscribe to the shares. So we always use the subscribed shares or the shares in issue. All right. Assuming you calculate the earnings per share and you are getting 0.025. Ghana cedi. What is the meaning? And what will this signal to a potential investor? All things
For
being
everyone
equal.
Ghana, for every one Ghana share you have in the company, it will give you
a return of what? Or part
a
of
return
the
of 0.025.
a return
Ghana
of
cedi.
a return of is it up to 20%? No.
No, it's not up to 20%.
Less than 10%.
Yes. So if as a potential investor, what is this telling you?
The company is not profitable.
No, that is why I say all things being equal. Okay, you can conclude that the company is not what? Profitable. Are you okay? Okay. It can also be, if all things are not equal, it can also be the company is profitable, all right, but they have a large amount of shares in issue. Are you okay? They have a large amount of number of shares in issue, but all things being equal, this will tell you that the company is not profitable. And as an investor, what are you going to do? What advice are you going to give to yourself?
Not invest.
This is also before declaring ordinary dividend too. This is before any ordinary dividend is being paid. This is before. This amount over here is before. Assuming they have paid dividend and you are calculating.
For a company that is not performing well, maybe every investor will decide not to invest.
Okay, but it depends on the purpose of the investor. You see, some of the investors are short-termists, and some of them are long-termists. Some of them,
Hello, sir.
yes, sit down.
Please. I was informed that with reference to investments, it is mostly advisable to invest in less risky environments. So with such a returns, it seems that the company might be a less risky entity, which means when you invest in that company, you're 100% sure of receiving your money back than investing in a company that promises a high returns on your investment, but you might end up getting nothing.
It depends on the purpose of the investor. That's why I'm saying that some of the investors, they are short-termists. They want their money, maybe they want the return, or they want to recoup their money within a shortest period of time. So if you are that kind of investor, you will not be encouraged to invest in this particular company. But if you're an investor that you believe in long-termist, then you can put your money here and be what you have to know that no African will even be willing to invest in this company. Yourself, Emmanuel, yourself. You will not be encouraged to invest in this company, although they are not risky. The company can also be risky. This company can also be risky, but just that they are not doing well.
We want one returns type.
That is what I also want to talk about. If the return is too high, that is also telling you that the company is a Ponzi scheme. You have to be very much aware of that. That number one type. Whenever
in Ghana, we don't know Ponzi, we know NAM1.
Okay. Whenever the return is too high, you shouldn't just stand up and say you are going to invest in that company. You should ask yourself so many questions. This company, what are they doing before they are promising you this return? It is possible that a company will be this thing will be a Ponzi scheme like NAM1's own. NAM1's own. So, but what we are saying is that yes, all things being equal, no rational investor will go and invest in this particular company, because the purpose of every shareholder is to maximize their wealth.
Reality.
Yes. So But the thing is also that the company should not be giving a match return. If the company is giving a match return, it can be like they are overutilizing their assets. But the return that you should give should also be reasonable. Should also be reasonable. So this ratio is telling us that, okay, for every 1 cedi that you are going to invest, you are getting what on it? Maybe that's me. I was thinking it's 25 pesos. It's too
Roughly
small.
3 pesos.
Roughly 3 pesos. That is too small. This one, an investor who is coming to buy 70% of the shares will be what? If the person is coming to buy 70% of the shares, the person will be okay. This means that if you have a larger number of shares, you'll be having more, isn't it?
Yeah.
Yes. But if you are coming to buy 100 shares, my brother, I don't count. All right. That is the earnings per share. But mostly the question is not set on the investment ratios, but anything can happen. Let's move on. The next one is what? The next one is,
Dividend yield ratio.
okay, dividend yield, which is calculated as dividend yield.
Dividend paid over number of ordinary shares.
Are you sure?
No.
So dividend yield is calculated as dividend per share
Okay.
over market price
Uh-huh.
per share times 100.
Exactly. Exactly. So what is this ratio telling us? No, please, there is no lecture note. I can't be writing formula. Why? Why should I write formula no. So you use the lecture plus the questions.
So please, the ratio again.
Is dividend per share over market price per share, the current market price per share. The current market price per share. There is no note on this, but maybe if you are moving, there will be a note on it, but not this sitting. Okay. The market price that we are using is current market price. You see, sometimes you can see that they will say the share is currently trading at 3 cedi, and you also see 5,000 or 50,000 that you see at 1 cedi. No, we're not talking about this 1 cedi. This 1 cedi is just the par value. You see, the time that you are registering the company, the registrar general will ask you to attach maybe an assumed value to the shares. But on the stock exchange market, the share will be trading at a price that is what? Higher or lower than this. So we only use the current market value. What is the value of a share in the market currently? That's what we are talking about. This can also be calculated as total dividends per share. The dividend per share that we are talking about is the ordinary dividend. Ordinary dividend per share divided by market price of the ordinary shares, current market price of the ordinary shares. What is this telling us? What is this telling us? Another name for this is cost of equity. Another name for this particular thing is cost of equity. Okay. Those who are doing financial management, this is cost of equity. Okay. What is this ratio telling us? Okay, let me use example. Let me use some example to calculate this. Mostly we are not familiar with the interpretation of the financial ratios, but it is well. Let's assume that dividend per share is 2 cedi and the current market value is 10 cedi. What will be the dividend yield ratio?
0 point.
Market value of
10. So 2 over 10 times what? 100. That will give us what?
20%.
20%. What is the meaning of this? What's the meaning of this?
Okay, sir.
Okay.
What it means is that the current yield on the shares in the stock market is 20%. That means if you invest or own one share in the stock market, you get a return of 20% on that share.
Okay. The idea is there. The idea is there.
The idea is there.
Yes, yeah. The idea is there. Yeah, but yeah, but the
idea come proper.
but the question is, we are all not familiar with the investment ratios. Okay.
Yeah.
Yes, yeah.
So can we also say that it means that the dividend that you are getting per share is 20% of the market price per share?
Exactly.
Okay.
Okay. That is also the meaning. But assuming you are not, if you are investing an amount which is equivalent to 10 cedi, it means that any time that we are going to do or we are going to declare dividends, you are going to get 2 cedi as a return. Okay. But if you are now investing 5 cedi, you can see that your return will be different from the person who is investing the 10 cedi, isn't it?
10 cedis.
So in general terms, they are saying that for every amount that you are going to invest in the company, we are guaranteeing you a return of what? 20%.
20%. Sure. Okay.
So that is the return on the investment. So for any amount that you are going to invest in the company, we are giving you a return of what? 20%. So this is where we are going to have the issue of the NAM1. They are saying that they are going to give you, if the dividend yield is 70%.
But that is cool chop.
It's cool chop. You see, okay, so you see some people that are smart, they'll put their money there for 2 years and go and take off.
Charlie. People enjoy it though.
Some people, they will even think about the money that they are going to make before they will go and invest. They will draw a plan. Okay. So the dividend yield is talking about for any amount that you are investing in the company is guaranteeing you this percentage on your return. We are using dividend. Dividend is the actual return to the what? To the shareholders, isn't it?
Hello.
Yeah. Yes, Ina. Yes, Ina. Yes,
Trying to call.
Someone want to talk?
It looks like he was talking on the phone.
Okay. So let's now come. So this ratio is telling you that as a potential investor, if you invest any amount in the company, the return that you are going to get on your investment is what? 20%, 8%. Assuming the return is 2%, what are you telling the people? What will be this 2% to the potential investor? He will be discouraged, isn't it?
Yeah, the market. You said that the market is low yield.
So the investment is not worth it.
Yeah.
You can take that money and take your family out. That would be better.
You go and chill, cry.
Yeah, they will enjoy. Thank you. You see, but if it is also 70%, look at this. If it is also 70%, you'll be forced.
It's risky.
Yes, you'll be forced to do it. And this one, you also have to look at maybe if care is not taking, the company can be out of business.
Yeah.
That was what happens to the men's good. You see, if this ratio is 70%, we are using dividends. We are using what? Dividends. It means that the company is paying much dividend out. and they are retaining what? A lower portion of profit. We are using dividends. So if the rate is higher, it means that the company is paying much of the profit as dividends.
Yeah, they were paying 70% of the profits.
And if you are doing that, what will be left for you to run the day-to-day activities of the company? That will also be a problem. And the company can be out of business.
Yeah.
Yes, boss.
This one is low too. Go grab your lucky.
Monday special.
Monday special.
It is well. It is well. So the dividend yield is talking about the return that the company or the potential investors are going to get on their investments. So in financial management, dividend yield is what we call return on equity or cost of equity. Okay, let's look at another one. We have looked at dividend yield, earnings per share. What again?
We have dividend cover.
Dividend cover. Why are you not people talking about the dividend per share? Dividend cover.
I think that one is too simple for people.
What? Dividend cover. How is it calculated?
Okay, so
Earnings per share
yes.
over dividend per share.
Okay, which can also be calculated as total earnings over total dividends.
Dividend.
This times number of times.
Number of times, yes. Okay. That is showing number of times our earnings can cover dividends or can pay dividends.
Okay. So what will be the position? If it is showing the number of times that we can use our earnings to pay dividends, then what will be the position? What will be the favorable position? Should it be higher or too low?
It should be higher.
Okay. So if it is 5 times, it means that the potential investors can say that, okay, if the company can use its existing earnings to pay the existing dividend 5 times, then it means that if you invest there, you can also get a return on it, isn't it?
Yeah, it will boost their confidence to invest.
So that is a dividend cover, which can also be calculated as total earnings over total dividends times the number of times. This is telling us the number of times that a company can pay dividends out of their earnings. Can pay. The next one is what? Let's move on fast. I want to talk about common size.
Dividend per share.
Okay, someone wants to say earnings yield. Why my pencil is fully? Okay, let's talk about dividends. This thing is why. Dividend per share first. Okay. Ordinary dividends. Ordinary dividends over number of what? Ordinary shares.
Equity shares or ordinary shares, yeah.
Okay. So this is telling us what? What is this telling us? Assuming the dividend per share is 0.005. Potential investor, what are you going to do? Potential investor, what are you going to do? 0.005. Potential investor. Potential investors, what are you going to do? The dividend per share is 0.005.
This one is not worth investing.
Hello, sir.
Yes, senior.
Okay, so what it means is that for every invested in ordinary shares, you get a return in terms of dividend of 0.005.
Which is what? Is it 5%?
Is it even up to 5%?
It's less than 1%.
This one, you
This-
better go
this
and
is-
buy your land and keep it.
This is infinitesimal, it's insignificant.
Okay. So the
When you
dividend
have about 1 million shares, you will see.
so it depends on the number of shares that you have. If you have more, you get in more.
Oh, that is
So
it's just not worth.
This one is just saying that for every 1 cedi that you see, the actual amount of money that will go to the shareholders is the dividends, isn't it? So they are much
Yes.
concerned about the dividend per share. So you are telling me that for every 1 cedi that I'm going to invest in the company,
I'm going to get 0.005.
it is what?
What about those with shares not receive dividend for the past 20 years? And nothing in reserve. Nothing in reserve too for them.
If I don't want to enjoy,
They are holding entitlement to as shareholders. They enjoy that.
And so you still hold the entitlement as shareholder and have your 0.005.
no, if you're not doing it for
Senior.
yourself, yeah.
This one, it looks like there's a company I worked in, and then in 2007, they paid dividend. Up till now, I've never heard of dividend. So, like this kind.
So this why if you are doing the investment for your children, your grandchildren, then you can leave it there.
No. You better go and buy land.
Okay. So the dividend per share is telling us in terms of actual return. If you have a share in the company, assuming the share is 1 cedi. So if you have a share, or for every shareholder, one person, for every share that you are going to have in the company, you are going to have a return of what? 0.005 Ghana cedi.
Wow.
But if you have 90% of the share there, you'll be chilling. Okay. But if you have 5%, you have to know that you there. Go and put that money somewhere. So this one depends on the proportion of shares that you have. Those are having the lower shares will be suffering. So this one, what you are going to do is that maybe they can give you the company itself, which 2019, they are telling you that the dividend per share was 0.10. 2020, you have calculated it and you are now getting 0.005. What is happening?
The value has reduced.
Okay.
The
So what
company
will,
is dying off.
what will be the, it can be that the company is not to pay enough dividends. Okay. It can happen that the company decide not to pay enough dividend. Maybe the company has made enough profit, but they don't want to pay enough dividend. But it's not logical that you make enough profit and you pay less dividend. Okay. And this one, the implication is that if the trend should continue like this, what will happen? Those who have the investment, what would they be doing?
They will sell off their investment.
They will sell off their investments. And even if the company want to raise new finances, they can't use equity.
Yeah, it will be difficult, yes.
They can't use equity. But assuming their interest cover too is unfavorable, they can't use what? Debt too. And if they are having
Yes,
problem with
yes,
their
yes.
liquidity ratios, they can't use
Yes.
short term too. So they will be out of business. But the thing is, you shouldn't pay more dividends, and you shouldn't also pay what? Less dividends. It should be what? Reasonable. The dividend payment should be reasonable. You shouldn't give more than you should keep.
And you shouldn't keep more than you should give.
Exactly. So it should be reasonable.
Yeah,
That
you
is
should
the
balance the situation. Okay.
That is the dividends. That is the dividend per share. Let's look at what we call dividend payout ratio, and we also look at price earning ratio, earnings yield. Then I'll talk about common size analysis. Okay, let's talk about dividend payout ratio. Dividends payout ratio. dividend payout ratio. How is it calculated? Okay, you made a profit of 100 Ghana cedis. You are paid 40 cedi out. So what proportion of the earnings have you paid as a dividend in terms of percentage?
40%.
40%. How did you get that?
Hey.
Oh, it's 40%.
Yes.
So how did you,
The amount, the dividend paid, that is the dividend paid over the profit made multiplied by 100.
okay, so the dividend payout ratio is calculated as dividend per share times what? 100. We are looking at what portion of the earnings or what portion of the profit is paid out as dividends. That is the dividend payout ratio. If you're having a dividend payout ratio of this, what is the implication?
It means you paid 60% of the earnings, or you use 60% of the earnings to pay dividend.
Okay, what would be the implication of that on the operations of the company? What is likely?
The business may not have enough funds or liquid assets to run the business because they've paid most of the earnings to the investors.
Okay, so would this ratio be appropriate for the company?
No, it isn't appropriate.
Hello.
Yes, yeah.
This will not be appropriate for the company because there are even some of the things that go into the determination of profits that do not necessarily bring cash.
Okay.
But once you declare profit and you decide to pay 60% of that profit, which is basically cash paid out to people,
yes,
it's not healthy for the company. And you will be draining your cash to the owners in terms of dividend payment. While in natural fact, the element that determines that profit did not necessarily bring cash.
So this is not good, isn't it?
It's not good.
Okay.
Yes, yes.
Can we also conclude that it depends on the nature of the company? It depends on the volume of the company's operations.
Well, that's also possible.
That maybe if they have enough reserves already.
That's what I'm saying. It's possible.
Okay.
Because, they would have had enough reserves in the past years, which is also reflecting on it seems someone is.
No, I've muted the person so you can talk.
So I'm saying that assuming in the past years they have better reserves, which is impacting positively on the cash or the liquidity situation of the company, then if this year you decide to pay 60%, I don't think it's that bad.
Okay. 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 But in the exam condition, this is very bad. Because
Yes.
you don't have access to other relevant information to determine whether they have enough surplus already or something like that. And we are not also saying that you should be having a dividend payout ratio of 20%. The investors will also be discouraged, isn't it? So all things being equal, at least if it is 30, 70, 40, 60, okay, it should be reasonable. It should be reasonable. It should not be paying much. It should also not be paying less.
Low.
Yeah. Yeah. Okay, let's move on. Let's look at price earning ratio. Price earnings ratio. price earning ratio. Yeah, someone stop.
Yes, so I wanted to find out. You said only 60% is not good for the company.
You said?
But
Yeah,
I
George.
say normally for the company.
George, I can't hear you. Talk, let me
George,
see.
just type.
Yeah, type. Okay, that will be better. Type that this thing. Let's look at price earning ratio. Price earning ratio. Price earning ratio. How is it calculated? Price earning ratio. The name itself. Price earning.
Okay, so the price earning ratio can be calculated as market price per share over earnings per share. Am I right?
Yes, please.
Yes. Okay. Okay. Thank
The
you.
market price per share over earnings per share. So what is this telling us? Sometimes you can make it times number of times, or you can just leave it as a number. Okay.
It's okay. Yeah.
What is the price earning ratio telling us? Okay, assuming the market price of the company is 6 Ghana cedis and your earnings per share is 0.05, what will be the price earning ratio?
Um.
The market
Okay.
price,
So
120.
it will be what?
120.
So what is that 120? What is the meaning of that 120?
so it's that means that is the total market capitalization of the company.
Okay, total market capitalization as in, because I'm confused.
As in the total value of the company in terms of its shares.
Hey, Chawa, I'm still confused. Oh.
I'm confusing you the more. Okay, so you coming.
Seniors will come in. Senior Felix is there.
Okay. Then Uncle Fifi, if Uncle Fifi is there, then I'm inviting him to come on board.
Linus,
Yes, please.
please let me try.
Okay.
So it's looking at how much the entity market price can be recovered through its earnings per share. So the market price can be recovered 120 times through the earnings that the company has, the earnings per share it has.
That is nice. That is very nice. That is very nice. I hope Senior Deborah will now be doing his head like maybe a lizard or something. Because all right.
Yes, sir. Yes.
Ghana Lincoln. You see, we have Abraham Lincoln, we have Ghana Lincoln too.
Yeah,
Yeah.
I
Today I
can
didn't hear
see
from you.
your dad shaking the head like this.
Yeah. Senior, I didn't hear you today, so say something.
Oh, I've spoken. Oh,
But I want to hear again.
you want to hear again? Then the next question.
Yeah, that is what we are saying. The 120. What is the implication of the 120?
The men are running away.
Yes, we are running away with our tails in between our legs. Let's go to the next one. Let's go to the next one.
Okay. Yeah. Yes. Yeah.
The price in this ratio, it shows the relationship between a company's share price and the earnings per share. When the ratio is rising, like this 120, it shows how it gives investors confidence in it gives confidence to the investors about the business. So it shows how the company's share price and the earnings per share of the company. So this 120 will give confidence to investors about the business.
Okay. All right. All right.
Yeah, someone has paid the men.
Okay. Okay. All right. You see, let's come here. It means that before we can get a six cedi over here, we need to multiply the earnings per share by what? 120, isn't it? All right. The
Yes.
meaning is also
Yeah.
that if I'm putting 6 cedi, if I'm buying one share currently, if I'm buying one share currently, this is the current price of the share. So if you are selling the share to me, it will be sold at 1 cedi, isn't it? So currently you are telling me that if I have to buy the share at 1 cedi, and if they are distributing earnings, if I have one share, if I'm distributing earnings, I need to wait and get what earnings per share, how many times? 120 times before I can get my 6 cedis back.
So can you say that again?
Okay. I'm saying that the current price of the share is what, 6 cedi, isn't it?
6 cedis. Yeah.
Okay. If I want to get a 6 cedi, if I want to get 6 cedi, and you are now currently, the earnings attribution is 0.05 per share. So if I'm buying one share, it means that I have to wait and get the share of the earnings how many times before I can get my 6 cedi?
120 times.
120 times.
So the times as in days, so what does the times mean?
The earnings per share, the earnings will be calculated every year. That is 120 times, 120 years or something.
So that means can we say that that's 120 years?
Exactly. If the earnings per share is constant like that.
Hey, the Methuselahs and the Isaacs, they are no more. The Josephs, they are no more.
No, if the earnings per share should be at this rate, if it should be 0.5 every year.
This one they are laughing.
Oh, that one you buy for your children.
Oh, sir.
You buy it for your children. So the earnings per share, if
they enjoy them, when they grow, they also do this and enjoy.
You see, you are just like Akufo-Addo. That is why he has used the Heritage Fund. You are just like Akufo-Addo.
Oh, sorry. I said, baby.
But I mean,
how can you not think about your next generation?
I'm doing this now. When they grow, they also come and do this.
If your father said he will not build for you, you come and build. By this time, you'll be paying rent.
Who said not paying rent?
Oh, as for building, I'll build for them. But for enjoyment, they're telling man for enjoy you.
Let's move on. Earnings yield. Let's move on to earnings yield. I have to talk about common size. Earnings yield. Earnings yield is calculated in the same way how we calculate the dividend yield, but just that the top is now earnings per share over the market value times what? 100. Okay. The dividend yield tell us the return, the percentage of the return that you are going to get from the dividends. But this one, in terms of earnings, we are guaranteeing you the percentage in terms of earnings. But the dividend yield, the return will be guaranteed on the dividend payments. But the earnings, the return is guaranteed on a what? On earnings, not dividends. The return is guaranteed on earnings, not what? Dividends. So the earning here will also be in percentages. But this one, they are guaranteeing you the return on what? Earnings, not dividends. These two, which one are you going to go for? Is it the dividend yield or earnings yield?
Technically, I'll go for the earnings yield.
Why?
Because the earnings is always declared before they come to dividend.
What if the company is trading on credit basis?
They are trading on credit basis.
Yes, they don't receive cash. All this thing is credit transaction. You see that the earnings over there is no cash. So the person who is having the dividend here will be having cash. Whenever they declare dividend, he is going to have cash. But you are not going to have anything. But you assume that.
Okay. Hey. Wow.
Okay. Someone is asking the difference between earnings and dividends. Yeah. Why are you saying wow? Or you won't go for the earnings yield again?
But all other things being equal, if the company is also trading in cash, then that means it is better to go for earnings, right?
No, it can still not be better. If the company is making a loss, the company can make a loss and still pay dividends.
How?
They can pay the dividend from other reserves. Or they can also pay last year dividend that they have declared, but yet to pay it. I mean, the dividend, they are not going to use profit. They are going to use cash. So we can declare dividend from the previous year's reserves.
Okay.
Okay. Someone is asking the difference between earnings and dividends. Earnings and dividends. What is the difference? Can we say the dividend is a subset of the earnings? Okay.
Yes.
So they are
dividend
saying
is subset of earnings.
They are saying
because
that
we normally it is out of earnings that we normally declare dividend.
Okay, it's earnings per share over market value. Market value per share. Earnings per share over market value per share. Okay, Auntie Diana.
Yes, same as market price.
Yes, it's the same as the market price per share. Okay. Auntie Diana, the earnings is the profit for the year. The profit for the year, not just the profit for the year. The portion of the profit that will be returned or that will be given to the ordinary shareholders, or the portion of the profit that will be put in the business for the owners. But the dividend is like interest, which is paid to the owners of the company. So the dividend is paid out of profits. It's actually cash. Dividend is the return that we are, like you put money in the bank. If you put money in the bank, the interest that you are going to get on it, we can also call it dividend. That is the return that you are getting. But the earnings is the profit for the year. Earnings is the same as the profit for the year. Auntie Dana, are you okay now? All right. I want to talk about another side of this one, which is a common size analysis. Common size analysis. Common size analysis. Common size analysis. Okay. For the common size, we have two types. We have the horizontal. Horizontal. And we also have the vertical.
Vertical.
Okay. The common size, we don't really calculate ratios. But what we do is that we establish an item as a base. And now use it to calculate the remaining items. So if you come to common size, we have two types. We have the horizontal. If they say horizontal, what is the meaning? It's like this, straight line, horizontal. Isn't it?
Yes.
Okay. And vertical is this one, isn't it? Okay.
It's also a straight line.
Okay. But the straight line is not.
One is lying, one is one is standing.
Okay. Okay. You see the common size that you have been doing in public sector accounting. That one is the vertical one, where the calculation will be done downwards. So for the profit or loss, we use revenue as the benchmark. Then we now calculate the other items as a percentage of the revenue. That is the vertical one. That is the vertical one. So if we have revenue of 200 cedis or 2,000, then you have cost of sales of 1,005. You now have a gross profit of what?
500.
500. Then maybe if you have operating expenses, if you want to do vertical analysis, you are going to use the revenue as the benchmark, as the base. Then you now calculate the rest on the revenue. So the first one will be revenue, which is 100%. The revenue itself will be 100%, which is 2,000 over 2,000. Then if you come to cost of sales, it will be 1,005 divided by 2,000 times 100. Maybe that would be like 75%, I'm sure. Then you come to this one will be 25%. This is what we call the vertical analysis, the vertical common size analysis. Vertical
I beg,
common
please,
size.
I beg, please repeat.
The vertical one.
Yes,
The
yes,
vertical one,
please.
what we do is that we use in a profit or loss, we use one item as a base. Then we now do the computation using the other items as a proportion of the base. That is the vertical. And that is what you do in a public sector accounting, where you are going to establish the revenue. Then you now use the other items as a proportion of the revenue. So if you want to do it for 20, assuming this is 2020. So you take the revenue for 2020 as the base, then you now take the cost of sales. Then it will now be cost of sales divided by the revenue figure times 100. That will be the percentage of the revenue that the cost of sales is taking. Then you also take the gross profit. You do the same thing, gross profit over the revenue times 100. That will give you the portion of the revenue that gross profit is taking. You count your operating expenses. If you have administrative expenses, you do it for the administrative expenses. Those who wrote corporate reporting last sitting, that particular question was vertical common size analysis. Vertical common size analysis. So the vertical common size analysis, you have already done it. If you have done public sector, the one that you have been doing over there is the vertical common size analysis. But the horizontal, based on this one, someone should give me how we do the horizontal. So the horizontal.
The horizontal is like comparing the same item on a yearly basis.
That's all.
Like you pick revenue. Let's say revenue is given for 2021, 2022, and 2023. So you pick the 2021 as the base, and then you compare it to 2021 and 2022 to see the difference, whether increment or.
Yeah. So we do this thing we do it for each item one by one. We show the change over the years. So you can take 2021, you can take 2021, you can take 2022, 2023. Then you can say, okay, you are going to use the 2021 as a base to determine how much the revenue has increased over the years. Or you can find a change in this, you can also find a change in this. Or you can find change over here. Then you still use 2021 to find the increment up to 2023. Or you can find this to this, then you now find this to this place. That is the horizontal. We do it for each item. But if you are giving more than a year, then you can now use, if you are giving this one, 2021 up to 2024, You see, doing it one by one like that, you are going to suffer. So you just ask yourself, what was the increment from 2021 to 2024? You can just do that and now do the analysis. So that is the horizontal one that that is how we do the horizontal common size analysis. The vertical one is where we use an item as a base, which is always revenue in the statement of profit or loss. And if you go to statement of financial position, it is always the total asset. The total asset. That is the common size. I have one question in the in the questions there concerning common size. We are going to take it and look at how we go about it. The next thing that we have to look at is report writing. How do we write reports? You are doing analysis of financial statements. So after calculating those things, you have to write a report to management on what you have gotten, on your findings. How do you write the report to the management? What you have gotten is what you are going to put in the report, but how are you going to go about it? So let's look at what we call report writing. Report writing. Report writing will always take like maybe 10 marks or more than 10 marks. So, and you have to know that if you don't get your figures correct, whatever you are going to be saying in the report, you'll be quoting wrong figures. You'll be quoting, I want to write report writing. I'm still writing reporting. Oh. Report writing. Okay. If you know how to write Momo is like the report. It takes the same format. So the report, they are now asking you that calculate these ratios and use the ratios to write your report. The report will always be written to assess the financial performance of the company or the financial position of the company. Last time we said that whenever they say you should assess the financial position of the company, they are talking about what? The performance. So you are going to use profitability ratios. Whenever they are talking about financial position, they are talking about how, if you look at the state of the company, how is the state of the company? So you look at the liquidity ratio, you also look at the gearing ratio. But whenever they talk about performance, you look at profitability ratios. So how do we write a report? They will ask you as a financial controller or financial accountant or as a finance officer of the company, should write a report to what? To management or board of directors. So report writing is like this. The format is, the first one is you say the people that you are writing the report to. So the first item will be to. Then you say board of directors. Who are you writing to? Okay. Then who is writing? Then we have from. From will be the financial controller or yourself. You can get yourself financial accountant or finance officer. The next one is the date. When are you writing the report? The date will not be given to you, but always use the what? The reporting date of the company. So you can use 31st or 31 December 2021. Then the next one is the subject. The report. Why are you writing the report on? Analysis. It can be the analysis of the financial performance. Analysis of the financial performance. Financial performance and financial position. Financial position of KK Limited. Okay, that is the subject. This alone will take like 2 marks. Report writing will take like 2 marks. So it's very important to know the format. The first one is to. Who are you writing to? Board of directors, which will always be the case. Who is writing? From yourself, financial controller. What is the date? When are you writing it? What date are you writing this report? 31 December 2021. Then the subject. What are you writing the report on? Analysis of the financial performance. You always get a subject from the question. Analysis of the financial performance of the company. You put the name of the company there. Then the next one will be the introduction. You have to give introduction. You can't just stand up and be writing reports. If the question doesn't ask you to write reports, don't go and write reports. If the question just asks you, analyze the financial performance of the company, just go straight forward, analyze the performance of the company. But if the question states that write a report, then you now put your analysis in a form of report. So the introduction, there is one that I normally use for financial reporting and corporate reporting. The time that I was writing, those are the things that I was using because my English is not good. So I have a memorized word for the introduction. So I will discuss that with you. Then if you like, you can also pick it. Okay. So I always start by saying as communicated earlier or as discussed earlier, as discussed or communicated. Those who have English can display the English here. Maybe I don't have.
Yeah. Yeah, the Cambridge people.
Yes. As discussed or communicated earlier, I hereby.
Percy, are you there?
I hereby furnish you with or present you. I don't want to use that English. Let me use present. I hereby present to you the report on the analysis of the financial performance and financial position of KK Limited. Okay, then I'll start. This report considers, among many things, the following ratios provided in the financial. Okay, let me take that one again. This report considers, among many things, the following ratios. This report considers, among many things, or this report was presented or was prepared based on the financial information given above. That is all. You can also put it like that. This report considers, among many things, the following ratios. Then you put the ratios there, profitability ratios computed based on the financial statements provided or made available. That is all. That is the introduction. Anyhow you want to write it, just introduce what you are coming to talk about. You are coming to talk about analysis and what are the things that you use. You use the ratios. You have done some recommendation, but they are not important in the introduction. The next one is the body of the report. The body of the report. The body of the report is where you are going to talk about the financial position. So financial performance. Then you can put financial performance as a heading there. The financial performance, you have to know that you are going to talk about profitability ratios or profitability analysis. You can start by saying that the performance of the company has experienced a massive decline in the year 2021 as compared to 2022, as evidenced by the gross profit margin, which declined from this percentage to this percentage, and also the net profit margin has also declined. The return on capital employed has also declined. Then you now say what might be the causes of this. Okay, there was a decline in the gross profit margin because the company was not able to control their costs, their variable costs, or the revenue of the company has reduced in 2022 as compared to 2021. This can also mean that the company has increased the price of their products, or the company was not efficient in utilizing fixed asset or the company receivable collection period has reduced, that might mean that some of the customers has been dealt with unfairly and they decide not to patronize the company for that again. What is the implication of this particular reduction? If the sequence should increase like this, the company might be in a serious problem where they might end up making losses in the future. That is all. You are done with the profitability side. The company is not performing well, or the performance of the company has declined significantly in this year. What is the proof? Why are you saying that it has declined? Bring the figures that you have calculated. The performance of the company has declined as evidenced by the gross profit margin, which stood at 10% in 2021, but now 6.5%. The net profit margin, which stood at 25%, is now 12.5%, and the return on capital employed, this and this. This might mean that the company was efficient in managing its variable cost in 2021 as compared to all done 2022. This will also mean that the company has increased the price of its product, that is reducing the revenue. The company has also not utilized anything that you think that will be possible for the reduction in the ratio. You talk about one or two of them as a causes, then you now talk about the future implication of this reduction. If the series should continue like this, what will be the position of the company? If the series should increase like this, the return on capital employed should experience this reduction in this sequence. It means that in the future, the investors might withdraw the investment and put it somewhere. You are done. You come to financial position of the company. The financial position of the company, you are going to look at the liquidity ratio and the gearing ratio. You can say the position of the company seems to be more favorable in 2022 than 2021. Why are you saying this? Because their current ratio has increased from this to this. Their quick ratio has also increased from this to this. What does that mean? It means that in terms, if the company wants to liquidate today, they can be able to pay their current liabilities or their short-term liabilities this number of times. This also means that the company was able to dispose enough of their stock to convert, or they are able to convert most of their stock to cash, or they are able to make a lot of what? Cash sales. They are able to make a lot of cash sales. That's why they are having more money in cash. If the position is not good, you can go by saying that the financial position of the company seems to be what? Shaking. Why are you saying that it seems to be shaking? Because their current ratio has reduced by this to this. What is causing that? It might mean that the company is applying aggressive working capital policy, where they are financing both their short-term and long-term assets through short-term means. That is why their current liabilities are increasing. So if you say the company is not doing well, why is the company not doing well? You bring the facts from the ratios that you have calculated. Then you now tell us what is the cause of these things and what is the future implication of this particular ratio. You say that. If you come to the gearing portion, you say the company is highly geared. Why are you saying the company is highly geared? If you are saying the company is highly liquid, why are you saying that? Because their current ratios are not favorable. What is causing that? And what is the implication of that? If the company is highly geared, why are you saying that? Because the debt to equity ratio seems to be unfavorable. It's too high. Their capital gearing ratio is also too high. Their interest cover is also too low. What is the implication of this? It means that the company is more financed through debt than equity. And what is the future implication of this? If the company should liquidate now, total portion of its assets will be used to settle the creditors, and the shareholders will not get anything. You are done with that one. If you are able to convince them, that is all. You come to conclusion and recommendation. Conclusion and what? Recommendation. conclusion and recommendation. So the conclusion, you can say that available evidence has suggested that the financial performance of the company is shaky, as indicated by the liquidity ratios or the various liquidity ratio, the various gearing ratio, and the company has not performed well in the current year, as indicated by the profitability ratios. So you just conclude by saying that the company is not doing well. Why is it not doing well? As provided by the following ratios or the liquidity ratios calculated. What will be the recommendation? If the profit margin has reduced, what are you going to recommend to the company to boost their liquidity ratio? Okay, they should work on, if you have calculated their inventory turnover period, you can tell them that they should work on the inventory turnover period. They should also work on a receivables days, and they should also work on payment of their short-term debts. They should also work on the payment of their short-term debts. If the net profit margin has reduced, what are you going to tell them? They should be efficient in managing fixed costs. They can also do advertising, or they can also give discount to the customer to boost their sales. That's the recommendation. If the gearing ratio is very high, what will be the recommendation? You can tell the company that they should sit with some of the holders of the debts. They should sit with them, or to talk with them and convince them that they should change some of the debt to equity. They should convert some of the debt to equity. If the gearing position of the company is bad, they can convert some of the debt to equity. If that happens, you see that the cash burden, the interest that they are going to pay, because the people are now shareholders, if the company doesn't pay dividend or anything, they will not say anything. But the interest, whether you make profit or not, it will still be paid. So if they convert it, then the debt burden on the company will now reduce. But if the gearing ratio is favorable, you can now advise the companies to go for maybe more borrowings to finance any project that they want to finance. That is basically about the report writing. But we are going to pick a question and use that particular question to write a report. I'm saying that
Chairman.
the format is very important.
Chairman.
Yes, yeah.
On behalf of the silent members, I ask that we postpone the class.
Silent members association.
You don't talk when the instructor is talking. So
Oh,
where are you
thank
getting the silent majority from?
No,
Thank you.
it seems like the thing is not going. But this one is just, we haven't done it.
Thank you.
We haven't done any question yet. So we do, I just want to finish the thing so that we do a question. It's a question that we are going to use to write a report.
So then when we meet, we just start with the question. Now I need to be better.
Have the idea of the report before we meet you.
The way my brother is quiet, no, he wants to sleep.
So have the idea. I'm not going to solve a question today. I just want to finish everything today so that if I'm meeting on Monday, we know that we are coming to solve questions.
Some of us are still in the office, so.
Oh yeah, we are still in the office.
So should we move the time to 7 p.m. so that you can still be in the office?
Oh no. The 6 p.m. is fine.
Okay. So seniors, this is all about the report. This is all about ratio analysis. I hope we have learned something new today. And maybe most of us, we have done ratio analysis at the university, the SHS level. Maybe we have a different orientation about ratio analysis after this one. So basically, it's not anything. The computation of the ratio is very important because it's the figures that you are going to use to write your report. Whatever you are going to say in the report, you have to back it. You have to back it up with evidence. The evidence is the ratio that you have calculated. So the calculation of the ratio is very important. We are writing an African exam. They can't give you formula sheets. You have to memorize the formula in your head. So the only way you can be okay with the formula is to be solving questions. Because the ratios are plenty. How do you memorize all these things in your head? You have to solve more questions. So the calculation of the ratio is very important because without the correct figures, the report the facts that you'll be talking about will not be correct. Your facts, you see, if you don't have the fact, if the fundamentals are weak, everything.
Hey, the exchange rate. It's
So the,
exposing them. Oh,
no, the report will expose you. If the fundamentals are weak, the report will expose you.
The
So,
SEA pass mark will expose you.
so you see, the ratio is 20 marks. You see, if not for anything, at least get like 14 or 15 marks there. Just know how to calculate the ratio. The report writing is just English. Whatever you are saying, make sure that you are backing it up with what? With an evidence, which is a figure. If you say the company is not doing well, why are you saying that? You bring the ratios that you have calculated. That the company is not doing well because this ratio and this ratio has reduced in the current year. What is causing that? What is the effect of that? If the ratio to continue like that, you see all those things, then that is how you come back. So at least ethical issues is 10 marks. Corporate reporting, financial reporting is 10 marks. For financial reporting, your own can be between conceptual framework or ethical issues. But the corporate reporting is always ethical issues for 10 marks. Question 3B or C, 10 marks. Ratio is 20 marks. Capital reorganization and business valuation is 15 marks. Now I've sent you a document today, which is 5 marks. So without you touching the consolidated financial statement and the standards, you can get like maybe roughly 35 marks. So go and do buga somewhere, get a 15 and add it. All right. So
yeah, presentation.
Since my brother is saying that
this strategy will work the latter days when we are trying to gather the 50 marks into our pockets. Then we'll be sharing this strategy.
No, I've given you at least. I've given you half of the pass mark already. I've given you 5 marks in the morning. I'm giving you 20 marks today. In capital reorganization, I'll give you 15 marks there. So you have 40.
And this one, I'll win award though.
I'm saying that if you are doing corporate reporting and financial reporting, you have a higher chance of passing.
Sure.
It's the management accounting people and the financial management people that we just be doing boga here. If we go, you see the same question. That is all. Okay. So, seniors, on behalf of the Silent Readers Association, our boss is saying that
you should adjourn the class.
Thank you.
But who said it? Who said that thing?
My name is Nick. I said it.
Okay.
Nick, where is your headquarters?
I'm reporting live from number 32 Saikoyo Street, Osu.
Hey.